Hey everyone, welcome back to 51%'s Crypto Research Podcast. I'm your host, Tom Shaughnessy. Today I had on Scott Andersen, a principal at FINRA.com, whose practice is focused on crypto. I wanted to have Scott on because he was also on the other side of the table as a prosecutor and has invaluable insight here from his experience. From March 2012 to February 2015, Scott was the regional chief counsel at FINRA in LA, where he oversaw all FINRA enforcement cases prosecuted by the LA office and managed the West region's attorneys. This was a far-reaching legal episode where we discuss recent enforcement actions against ICOs, including Paragon and Airfox, and we even discuss Etherdetla and what this means for the future of the space. Scott also opines on numerous other topics related to crypto, especially on what he expects will happen in the space. This was our first legal-focused episode, and I learned a lot. I hope you do too. As an aside, this podcast is an arm of 51% Crypto Research. So if you enjoy the podcast, be sure to visit 51pct.io and see our extensive research library of crypto content crafted for professional investors, analysts, and funds. In a world of news and alerts, 51% is focused on original and extensive crypto analysis, written and researched by ex-equity research analysts. Click the link in your show notes or visit 51pct.io and enter your email to see one of our full research reports and why 51% stands out. In a bear market, it's a great time to consume real research. Our listeners can join 51% with coupon code Thanksgiving, which expires soon. With that, here's my conversation with Scott. Hey everyone, welcome back to 51%'s Crypto Research Podcast. Today in the podcast, I have Scott Andersen, a principal at FinLawyer.com. Scott, how's it going?
It's going very good. Thank you for having me today.
Yeah, it's great to have you on. You're our first legal expert we've had on, so I'm excited to get underway. So, Scott, tell us about your background and how you got started in crypto.
So my background is I'm a 19 and a half former securities regulator, initially at the New York Attorney General's Office Securities Bureau, where I prosecuted criminally securities fraud cases. I moved on from there to the New York Stock Exchange Division of Enforcement, where I prosecuted violations of exchange rules and the federal securities laws, both individually and as what was called an enforcement director, where I oversaw a team of investigators and lawyers who built and brought those types of cases. And then when I was at the NYSE regulation merged with NASD regulation, which oversaw the NASDAQ market, and formed what's called FINRA, the Financial Industry Regulatory Authority, where I continued to work as an enforcement director, both on the East Coast in New York City and on the West Coast in Los Angeles, ultimately as a Deputy Regional Chief Counsel of Enforcement in the West region.
That's interesting. So you've been on both sides of the table, and now you're on basically the defense side, not to put it in layman's terms?
So in the crypto space, my law firm is divided into two practice areas because I spent my career building enforcement cases. It just made sense when I started my legal practice in 2015 that part of the service that I provide is helping people who receive a FINRA 8210 request letter, an SEC subpoena, or a subpoena from another securities regulator. The other half of my business is my practice is a little different because I don't do traditional transactional work. For example, writing private placement memorandums, doing securities registration filings, things of that nature I don't do. But what I do is I give a lot of regulatory and compliance advice, both to market intermediaries like broker-dealers or investment advisors, as well as issuers or people seeking to raise capital over the internet or otherwise, and are very interested in complying with the federal securities law.
That's interesting. So before I want to talk about a lot of recent events, and it's very timely to have you on with everything going on, but I'd love to talk a little bit more about, your time at FINRA and your time there. I mean, what do you think that the government entities like FINRA are thinking about the crypto space here today?
So keep in mind kind of the lead in all this from the regulatory side, at least with respect to securities, is the Securities and Exchange Commission. And I'm actually of the viewpoint that the SEC has been very kind of thoughtful and methodical with its approach in addressing cryptocurrency, because I think it has a deep understanding that the last thing that it wants to do is push offshore a budding technology that could create jobs and improve the economy in the United States. But with that in mind, one of the critical missions of the SEC is investor protection and making sure that investors who participate in the securities markets, either with an ICO purchase or buying a security in the secondary market, that those investors are protected from being defrauded in that they have all material information related to the investment being offered to them.
That's interesting. So I back to your point. I mean, I totally agree with you on ceding technology to other nations. I previously helped cover telecom, and 5G was a huge argument. And basically, there was the United States didn't want to give up that technology to another nation and lose the race, like China, Korea, et cetera. And I think that a lot of the same is playing out with crypto. I mean, are you surprised by basically kind of like the light hand touch that the SEC's taken over the past year? I mean, other than very recent events, because it seems like they've had somewhat of a vague hands-off approach over the past year.
So it's very interesting to me because I became kind of actively involved in the space last year in October, I think middle of October of 2017. I wrote a blog post where I was addressing the SEC report on the DAO, as well as addressing some recent SEC. I think there was a recent SEC action, and essentially, what I talked about in that document, there was actually two blog posts, one in October, one in early November. What I talked about those is that when you're talking about raising capital through the issuance of a token in the form of an ICO, the threshold question is what you're discussing here a security. And if it is a security, there's going to be a lot of additional questions that the SEC is going to have. When we talk about the securities laws, we talk generally about the 33 and 34 Act, but also the 240 Acts. One is the Investment Company Act, and one is the Investment Advisors Act. And if you have a security, if you have a party, for example, who's facilitating the sale of that security and receiving a commission, that party would need to be registered as a broker-dealer. If you have a party providing investment advice related to a security, that party would likely need to be registered as an investment advisor. If you set up a platform which exchanges what are called securities, that exchange is also going to need to be registered under the 34 Act. And essentially what I attempted to do in these blog posts is kind of identify that the initial issue is, how do you interpret the Howey test? And I think the media catalyst to me writing the blog post was I saw on the internet that there was a test which was actually brought to my attention by a former law school classmate of mine who actually went the business route and never practiced law, who was exploring, whether a product would constitute a security. And what he did is he found and he pointed out to me that there's actually tests you could take on the internet to see, depending on what the answers to the test are, you could determine whether or not something is or is not a security. And my reaction to that was, what? That doesn't make any sense. This is not how these things are determined. There's a lot of case law. You start with Howey, the Howey test, which is very well established. And also, keep in mind that I've been doing this work for a long time, and every decade what you see is another product that is being presented as a non-security, whether it's, for example, one maybe a decade ago was collectible coins, where there are arguments that collectible coins are not securities, and then, of course, the SEC opens up an investigation, does its case, and then ultimately the court, for the most part, determined that what we are in fact dealing with is a security. So it was kind of predictable for me what happened next, and what I was trying to do was talk about that security as only the threshold question is just the first question. But once you answer that question in the affirmative, you have all these other questions and regulations that become applicable.
That's super interesting and a great overview of your thoughts there, Scott. Really appreciate that. So, taking that a step further, I mean, how do you feel about, I've had a lot of security token and basically ICO token in some senses platforms on. I've had Polymath on, I've had Harbor on, I've had the parent of Token Foundry, which is Consensus Capital on. And they all take different approaches to do, whether it be ICOs or security tokens, where they kind of trade off either platform approaches for, different compliance aspects and things like that. But I'm wondering your thoughts overall on them. Do you think that these, security token or ICO platforms are, generally in compliance today, or do you think that a lot of what they've been doing kind of falls out of compliance? And I know this will go into your point on the exemptions that the issuers could use. If that's more interesting to talk about, we can go there instead.
Sure. So what's funny about all this is one of the things I was extremely interested in, other than doing something a bit entrepreneurial after being a regulator for so many years, was in 2012 the Jobs Act came out, and the Jobs Act, from securities law perspective, was quite revolutionary. What it essentially did is it expanded the Regulation D, Rule 506C exemption in Title II of the Jobs Act to enable what's called general solicitation, which is basically advertising. In that sense, the importance of this change in Title II was that it enabled people to advertise their private offering of securities, their private placement securities. They now could be advertised in a 506 offering, which of course could only be sold to accredited investors, which are investors with a net worth in excess of $1 million, or if they're single, have had a annual income in excess of $200,000 for the last 2 years, with an expectation that they're going to have that same amount of income in the current year. In addition to Title II, Title III came out, where the Securities and Exchange Commission amended a very long-standing other regulation that was in disuse, which was Regulation A, which dates back almost to the 33-34 Act, I believe, but hasn't been used, primarily not because you could only raise $5 million, and you had to get approval from all states where you were offering and selling your securities. There's a concept in securities law where, keep in mind that while the SEC is the federal regulator, every state has their own state securities regulator. And one of the significant problems with Regulation A, as it was drafted initially, was that there wasn't preclusion of state jurisdiction to approve your offering. So in essence, what you needed to do if you wanted to do a Reg A offering, you had to get approval with the SEC. But then if you wanted to sell in New York, you had to go to those regulators, as well as regulators in every other state, to get approval. Now, a very famous case, probably talked about too much, but it just kind of makes a point that at one point in time, the state of Massachusetts denied permitting a company to be registered because they felt it was too risky and to be sold to Massachusetts residents, and that company was Apple. And we all know where Apple went after that. So what happened with Title IV of the Jobs Act is they expanded Regulation A, so that if you did a Title II, Tier 2 of Regulation A, you could raise up, instead of $5 million, you could raise up $50 million in a 12-month period. And also there was the availability for investors in Regulation A to be non-accredited, meaning you could have broader capital participation by United States residents, even if they're not accredited. subject to some certain limitations on investment. And of course, the third piece is what everybody kind of calls the Jobs Act, which is a misnomer, and that is regulation crowdfunding, which was Title III, which resulted in the creation of the funding portal, which is essentially a mini broker-dealer, which is able to help small United States companies raise $1 million. Right now, it's a little bit over that based upon an inflationary adjustment. And the kind of the rules with that, again, were that the offering had to occur on the internet, on the funding portal. There were certain requirements for making material disclosures, of all material facts, so the investors were understood kind of the risk they took with making the investment. And of course, non-accredited investors, again, subject to investment limitations, could participate. So you have what is the creation of the Jobs Act, this revolution that enabled now non-accredited investors to participate, and advertising to occur over the internet. And while all that was, building up, some more successful than others, for example, Regulation D, 506C was like the marriage between the real estate industry and the securities industry, because a lot of real estate professionals were using that to raise capital for real estate projects. Regulation A struggled some more, and regulation crowdfunding has some significant issues based upon the limited amount of capital that you're unable to raise, and hopefully the SEC will raise that at least to $5 million to make that exemption more useful. But while all of this stuff is going on in 2015, 2016, suddenly this explosion occurs, and we hear about the ICO. Kind of a unfortunate title, because it sounds like an IPO and automatically puts the SEC in a position, whereas this sounds like a security, but where the ICOs suddenly raised much more money than you were raising under their Jobs Act, with the exception of Regulation D, which is a tremendous source of capital raise.
Super, super interesting, Scott. And it kind of reminds me, I was a microcap investor and ran a research site back in the day focusing on that. And Crowdfunder, I think, and WeFunder were a few of the websites taking advantage of some of these regulations. But going back to your point here, I mean, do you think that a large majority of these ICOs or STOs, we just want to group them all together for ICOs just for argument's sake, do you think that a large percentage of these offerings actually use these exemptions, or do you think that this is few and far between?
Well, they didn't use the exemptions at all, and that for the most part. Certainly there are exceptions here. For example, if you use staff, purportedly you're falling under Regulation D, but that's the whole idea of the STO. The STO is getting back to the concept of compliance with the securities laws, and basically you have two rules. One is if you sell securities within or from the United States, your security either has to be registered with the SEC, or it has to fall under an exemption to registration. Essentially, the Jobs Act was an expansion of some of these exemptions, as we've talked about. And I think what the STOs are attempting to do is to write in certain code into the tokens themselves so that the tokens will be compliant. For example, if you do a Regulation D offering, the security that is purchased is restricted under law. And there are certain requirements that have to be complied with. Generally, there's a safe harbor called Rule 144, which has to be complied with before that security could be liquidated. I think what the security token providers are seeking to do is write in that restriction period, for example, of a period of 1 year, to make sure that somebody doesn't purchase a security token under Regulation D and then immediately sell it. So essentially using the smart contract concept to lock in and write in the restrictions required by securities regulation.
That's super interesting. So where do you see these security token platform or ICO platforms going? I mean, do you think that they're going to go out of business, or do you think that they'll pivot to make good on what they have to do legally to be in compliance?
So I think the security tokens are a tremendously good step for the industry. And again, what they're essentially doing is they're trying to work in, as I understand it, they're trying to work in the securities exemptions available for kind of the token ecosystem. The problem that we have here is that the token ecosystem doesn't fit neatly with the securities exemptions. For example, when you think about ICOs, I mean, there are some very interesting ICOs, and there's some ICOs that were very borderline and questionable. But for the most part, what we're talking about is a concept where we're raising capital to build an ecosystem, a token ecosystem, where the token will have utility to be used in that ecosystem after it's built. The purpose of selling the tokens was to raise capital to fund the ecosystem. So when you think about that, and you think about the distribution of tokens that have utility so that there could be participation in the ecosystem, number one, you don't want the tokens to be limited to a distribution to accredited investors, right? I mean, number one, that's a very small percentage of United States persons, but also, for a token ecosystem to work, you want the token to broadly be distributed to people who would be interested in that ecosystem and using that ecosystem. So if you distribute the tokens, for example, under Regulation D, you have that issue. If you deposit the tokens under Regulation A, which, as I mentioned, enables you to include some not accredited investors subject to investment limitations, the problem that we have with that exemption presently is that the SEC hasn't yet approved any of Regulation A exemption. Regulation A offering as an exemption for a token offering. And I think the problem there is the SEC is continuing to get its arms around what are the material facts that have to be disclosed when we're not talking about a traditional Delaware corporation selling traditional securities, but when we're talking about what we're thinking about as a organization that's based on the blockchain that doesn't have a traditional history that's issuing tokens. What are the other disclosures that need to be made? And I think that's been an issue with respect to that exemption. With respect to regulation crowdfunding, we're talking about when we look at ICOs raising millions to multi-millions to even billions of dollars, and $1 million under Title III of the Jobs Act really isn't going to be helpful to get that started. So just to get back to your question, well, I think what the STOs are doing, and I think it's the right direction. I think it's not a perfect solution, because the exemptions, unfortunately, aren't designed to address kind of the new technology and ecosystems that are being issued with token technology.
That's extremely insightful, Scott. So basically what you're saying is that the current rules don't allow like a large expanse of investors to take place in an ICO, but that's needed to build a thriving community where the token will actually be used, whereas catering to large institutional investors is doable in a sense, or hopefully, but it wouldn't actually solve the community, the synergistic community building that these platforms hope to build, because you can't market to that many, and there's kind of, their predisposition is basically to invest, not to actually use the community, which is interesting.
Yeah, and keep in mind that I mean it was the idea of the ICO that created this problem. I mean, if you distributed tokens that have nothing to do with the capital raise, I don't think the SEC would have been largely concerned. But what happened in a lot of these ICOs as we go through the enforcement cases is the token was used as the mechanism to raise capital, whether somebody was receiving equity or some other interest through the receipt of that token. depends on a case-by-case scenario. But what you have is a consistent storyline where the tokens ultimately get put on an exchange. They get put on an exchange because the exchanges would be freely tradable. Again, with the underlying premise that if they're freely tradable, we'd want to trade them, that we have some sort of belief or expectation that the value of the tokens that we purchase would increase in value. And these are supported by the marketing and solicitations by the ICO issuers. In many cases, as detailed in the SEC enforcement actions, very actively talked about as we're building this ecosystem. The token you buy from us now is going to increase in value, and you'll be able to sell it on this non-registered, non-security exchange marketplace at a later date for an increase in value. And for a long time, that was true. People were seeing the dramatic increase in cryptocurrencies. Of course, that has changed tremendously in the last few days. I think with Bitcoin reaching its lowest trading level that it's ever had in at least over a year, perhaps more than that.
That's interesting, Scott. So just to sum up before we move on the ICOs and the STOs, I mean, the bear thesis out there is that a lot of the ICOs will have to return their money to investors. I think it's extremely problematic for several reasons. The first one being, America cedes kind of this technology to another nation, and then the other thing is the actual enforcement of that would be very hard, and that would drive crypto prices down, and these companies might not even have the crypto to return. So I'm just wondering, what is your take here at a high level? Do you think that the ICOs will have to return all investor money, or do you think this is case by case basis, or just interested in your thoughts here?
So at the end of last week, of course, there's the Airfox and Paragon SEC enforcement matters were publicized, and both of those were ICO offerings that constituted securities under the Howey test. And essentially, the importance of that enforcement action, I think the message that the SEC was trying to convey to the public with respect to that enforcement action is if you issued an ICO and you didn't do it in compliance with the law, there is a way for you to make your business compliant with the United States securities laws. And essentially, what the SEC required in those two cases was that these two ICOs file registration statements with the SEC to make their tokens be fully registered, and then give an offer to each investor who purchased the tokens, include the information that's required to be provided in the registration statement filed with the SEC, again, with the idea so that the investors are aware of all material facts relating to the tokens, to enable the investor to make a determination as to whether or not they want their money back. As I look at this, it appears the investor could say yes or no. If they want their money back, that would include the requirement that the issuer repay the investor those funds. That was part of the agreement. But there could be potentially investors that determine to remain with these particular offerings. I think you're right with your point that, keep in mind, I mean, a lot of the ICOs, at least from my perspective, were fraudulent in nature. I think when the SEC began bringing its ICO cases, there are always these fraud components. And by the way, this is a simplification, but when you talk about securities fraud, what you're talking about is the failure to disclose all material facts when you're selling a security. So the idea occurred, I think, with Munchie as SEC continued to bring cases that they were no longer limiting their cases to just fraud actions, but also violations of registration requirements. If you have to be a registered broker-dealer, if you have to be a registered exchange, et cetera, et cetera. This particular case, as I mentioned, the Airfox and the Paragon case, enables a methodology for ICO issuers to get into compliance. I think with others, they raised the capital. They used all the capital. And forgive me for the background noise. You can tell I'm in New York City. They raised the capital. They started building their ecosystem, assuming that they're complying with what disclosures were that they made when they were selling their ICO, and now the money's all gone. And in those instances, those entities are not going to have the ability to reach this type of disposition with the SEC that these two issuers were able to do. So
that's interesting. So I guess, do you think that, let's say, all of the ICOs don't have to return money and they favorably are able to do these things set forth that they're required to do to remain compliant. Do you think that, this might go the civil route with, investors just suing ICOs that they put money into for losing it, basically? I'm just wondering, if like the government doesn't come down, could this just end in civil court?
So keep in mind, I mean, that the SEC investigations by the SEC are all civil in nature, meaning that they're civil remedies as opposed to criminal remedies with respect to them. And I think you're right. I think the SEC has limited resources, and because it has limited resources, it can't bring every single case. And what it does is it tries to be thoughtful in the cases that it is bringing, and then to publish those cases so that people understand what is prohibited, so you have a deterrent effect. Now, when the ICOs started occurring in these issues as to whether or not it's a security were raised initially, what you saw was a whole host of class action lawyers jump in and start bringing civil cases on behalf of aggrieved investors. Again, under the theory being that if people are buying security, the security has to be either registered with the SEC or fall under an exemption, and all material facts need to be disclosed. And I think you had a number of class actions being brought against ICOs that raised large amounts of money, or else from a business perspective to pursue a defendant ICO issuer that doesn't have significant capital. At the end of the day, you're going to win your case, but you're not going to have any type of collection on a judgment because the ICO is not going to have funds. So I do think that there are a number of cases, and there will be more in the civil realm to look to bring actions again under the securities law.
That's great. Great insight. So Scott, do you think that this is like, peak bear market territory for like legal actions and all the negative commentary coming out of it? Because in my mind, there should be a point where, the government and the crypto realm start working together to kind of drive, Web 3.0 and create the platforms of the future. And to do that, I think that they're going to have to work together. But it seems like every time I open Twitter, I just see another negative event. I mean, when do you think that the tide will turn where these two ecosystems start to work together?
I think it has. I think what we're seeing happening now is people who are interested in this space, who want to do token offerings, understand there has to be compliance with securities laws, and they're looking at the available mechanisms for doing so. For example, you have companies that have filed a full registration statement for token offerings, and as I alluded to earlier, you've had companies file a Reg A exemption statements with the SEC seeking to get approval for those. Now, while there hasn't been any that have yet been approved, there has been an open dialogue between legal counsel representing those prospective issuers and the SEC as to what are the material disclosures that need to be made when you're talking about a token offering, as well as other issues related to custody valuation, things of that nature, which in my mind are more significant legal legal questions than the kind of the predicate security. Is it a security question? Similarly, you have people who are regulated intermediaries in the investment advisory space looking at the space. You have registered broker-dealers looking at the space. You have a number of applications with FINRA and the SEC seeking to create what are called ATSs, alternative trading systems, to enable lawfully to trade security tokens in compliance with the federal securities laws. And with all of these applications, you have dialogue. And I'm a true believer. Again, I've mentioned previously, I believe the SEC has been careful and thoughtful in its approach here, and I believe that's the case because they don't want to push technology offshore. And I also believe that there will come a time that the ATSs, Reg As, registered securities offerings, and the ETFs will be approved when the SEC comes across the right application that it feels addresses all the issues that it's concerned about.
That's super interesting. So, I mean, is there a point at which you think that those in the ecosystem will say, hey, we're not getting the guidance we want out of the SEC. Let's go in waves to other countries? Or do you think that, they'll be working together closely enough that probably won't happen? Because I think, as we both agree, I don't think the United States wants to kill possibly the most revolutionary technology in the last 100 years.
Well, keep in mind, number one, I mean, we have blockchain ETFs. The SEC has approved blockchain ETFs. Realty Shares in San Diego, I think, was the initial one that issued that. There are some very serious issues relating to kind of the securities laws, and I think when you think about United States securities laws and the United States markets, our markets have been so successful because of the laws that protect investors who participate in them. And ultimately, what I think, the changing point for the cryptocurrency blockchain ecosystem is going to be when the institutional investors come in. The institutional investors are going to actively want to participate in this market when this market is compliant with the securities laws, meaning that it's regulated and the people who participate through investing are protected by the laws, including full disclosure, resolving the custody issues, evaluation issues, and issues such as that, which enables the market participants, market intermediaries, registered broker-dealers, investment advisors, investment companies, all to get into the ecosystem and participate.
That's interesting. One of my first posts on 51% was on custody, and then I did a follow-up one on ETFs, and I kind of argued on the custody report that major institutional investors don't want to deal with a startup, and they want to deal with a JP Morgan or a Goldman Sachs. So we won't see inflows until we have one of the major banks offer a legit custody offering. And I'm just seeing news now that BAKKT by ICE got delayed until next January. I mean, what's your take on, real institutional involvement, either in the form of real custody offerings or in the form of a consumer ETF that's, point and click on Fidelity? Because a lot of people argue that could drive the next bull run, whether it's, major institutional involvement or a very easy to use, consumer ETF, kind of like, that's targeted towards retail investors.
Yeah, well, the cyber attacks of some of the crypto exchanges the last several years have made a lot of people very concerned about if they participate in on an exchange platform, will their assets be safe? So when you think about the securities laws, there's been escrow services provided by banks for years. A number of these banks, when I'm using the term bank, I'm not talking about the traditional depository institution that we all think about where we have our checkbooks and our savings account. But what I'm talking about is the definition of bank under the Securities Exchange Act. I think it's Section 386, which defines a bank as an entity that has fiduciary duties and obligations to its customers. What you have already in this ecosystem is you have a number of trust companies that constitute and fall under the definition of banks and can legally act as custodians. When you think about a securities offering involving a registered broker-dealer, that registered broker-dealer in a offering, it's called a mini-max offering that has a minimum contingency before that offering is successful, meaning if they're attempting to raise $10 million, the minimum's $1 million. The offering is successful after that $1 million is raised. They're required to use a bank under Section 386. A number of trust companies that are currently in the crypto space do meet that definition of bank, and because they're endowed with these fiduciary obligations to their clients, and if the bank is willing to enter into an escrow agreement to hold the proceeds in escrow and then to distribute the escrow when the contingency occurs. Again, if the contingency fails, the company fails to raise, in my hypothetical, $1 million, the money would need to go back to the investors. But if it was a successful offering that raised more than that amount, it would go to the issuer. So you have a number in the space who have that ability to legally serve in the capacity of custodian. But again, there's issues as to when you use these institutions, how protected are we going to be against cyber attacks, which I think is the main issue. But there's other legal questions with respect to custody as well. I agree with your premise. The more big players that are involved in the industry, the more comfortable institutional investors are going to be in participating in the industry. And I think it's just a matter of time before we get to that. That's
interesting. So, Scott, let's move on to the future of crypto, and interested in your legal opinions here and where you think the space is going. I mean, at a somewhat vague or high level, it kind of feels like crypto is, everyone knew that crypto would have to meet mainstream somewhere in the middle, like regulations and Wall Street in the middle somewhere. Bitcoin maximalists will disagree with that, but Bitcoin's price is tanking on actions from centralized entities, so it's hard to argue with that point. But where do you see crypto in 5 or 10 years? Do you think that it's going to look a lot like Wall Street with KYC and AML and all of these hopefully new more amicable regulations, or do you think that there's an opportunity for this to go sideways?
So it's funny because I think there's a congressman who recently proposed a bill taking digital tokens out of the security realm. Something, by the way, that I anticipate will not be successful. But you have two pathways to go. Number one, as I mentioned earlier, if you're talking about the distribution of a token that has nothing to do with the capital raise, which would not implicate Howey, you have the ability to distribute tokens in such manner, I believe. It'd be very helpful if the SEC provided guidance or no action relief that would give some guidance as to when a digital token would not be a security, what would be the necessary element that would require for that particular distribution. And again, maybe distribution is the wrong word to use, because I don't want to suggest it's distribution of a security if it's not connected to a capital raise. But I think you have the ways to have tokens distributed to the public, and then for the capital raising to be done in more traditional ways, again, falling under the registration requirements or falling under a securities exemption. When you're talking about the security token itself, I do believe in the United States that there's a lot of work being done right now, particularly in the ETF realm, where we have ETF after ETF attempting to become approved by the SEC, and the SEC raising questions with respect to custody for security tokens, of course, just simply being computer code. Other custody issues for those, relate to, how do you validate the existence of that token? How do you ensure that that token that's being held, for example, by an investment company or fund, is the exclusive ownership? The rapid downswing in the trading of Bitcoin and other cryptocurrencies recently highlights another major issue I think the SEC's been trying to work through, and that is the issue on valuation. How do you value these assets when you receive them as a market intermediary or as a fund? When you have such volatility, literally you could receive them and an hour later the price could change. How do you price them? What exacerbates that, I think, is kind of the fragmentation in the market and the unregulated nature of the market generally. But as you were mentioning just a few moments ago about the recent changes with, I think it's Bitcoin Cash, how do you value these projects or tokens if there's a hard fork and now there's two tokens instead of one? How do you value each if you're holding it in the account of an investment company act where you have regulatory obligations to give your investors accurate appraisals of the valuation of the assets being held? Another example here is if you have an ICO that is also doing airdrops, giving tokens away for free. Some people are buying the tokens at X market prices. Other people are receiving them free. How do you figure out how those tokens would be evaluated in that context where they're also been provided for free? So what I see eventually is us working through these issues. And when I say us, I mean basically the lawyers representing the participants who are pushing this budding technology in conjunction with working with the primary regulator, SEC, to work through this. And I do see the ecosystem growing in a regulated fashion consistent with traditional notions of securities laws.
That's super interesting, Scott. So, I mean, what do you think we would have to see to turn the tide legally from the government here? Whether it be the SEC or whoever. What would be the action that you would like to see positively, and when do you think that we'll see it?
So let's talk about the director of the corporation finance's speech in June 14th of this year, because I largely think that was a very significant statement.
William Hinnon?
Yes.
William Hinnon,
sure was.
SEC, yep.
Yes, that was his speech. Yep. What he did there was he raised kind of a revolutionary concept in securities law, in my view. Basically, the concept where you could have something that was at one point a security that at a future time may no longer be a security because it becomes decentralized. Very, very fascinating kind of a concept, because traditionally there hasn't been anything in the securities laws that I'm aware of that raised such a concept. And by the way, I should be more specific. The speech I'm talking about was on June 14th. It's called "When Howey Met Gary Plastics." Howey, everybody knows the significance of Howey in this space. Gary Plastics was an interesting reference point. And the reason why Gary Plastics was included in that speech was because Gary Plastics was a private lawsuit that involved the sale of a CD, where the argument was made that the sale of the CD was a security. Now, what's interesting about that case is a CD is specifically not included in the definition of security under the federal securities law. And the point that the SEC was trying to make with that case is, even if you have something that isn't a security, like a CD, but it's sold in such a manner that makes it a security under the investment contract theory that's set forth in the Howey case. Even something like that could be a security. The point that I'm trying to make here with this possibility that with decentralization and no longer reliance on a third party for managerial or entrepreneurial effort, you have a product that is no longer a security. The reason why that was significant, because that explicitly, and again, keep in mind, this wasn't a statement by the commission, the Securities Exchange Commission. It was a statement by the head of one of the significant divisions at the SEC. But again, even having a significant position like that, you don't speak on behalf of the commission. But what was incredibly interesting about that and why it was so important is it specifically took Ethereum out of the realm of being a security. In other words, because Ethereum now is decentralized and it isn't controlled by any single party, Ethereum is not a security. If the SEC wanted to tank the industry, it would have said Ethereum did an ICO. So because it did an ICO, it was a security then and security now. And I think taking that position would have been extremely damaging to the ecosystem in the United States. But by offering this...
Scott, that's super interesting. And just one question there. I mean, so basically he said that Ethereum wasn't a security because it's so decentralized and progress or expectations don't require one person. I mean, that could definitely be argued, but it was great for the space. But isn't it kind of weird, though, that, you know, they brushed off Ethereum, which was positive, but now they're going after all the ICOs that raised under Ethereum? It kind of just looks like another way to kill the industry, if that makes sense.
So I don't think so, because I think with Ethereum, and again, I mean, the importance of Ethereum is it's almost like the Apple app store for your iPhone for the blockchain industry, at least for the Ethereum blockchain, where it's the building blocks for all of these ICOs that are decentralized. I think what the commission was saying here is that continue building this stuff, but when you sell it, if you're gonna sell the tokens that you're building as part of a mechanism to raise capital for building your ecosystem, you have to comply with the securities law. And again, you could go back, you could look at my blog post. What has happened was highly predictable. Once, as I mentioned, once that predicate question was answered in the affirmative, that you were talking about a security, then you had to comply with the Investment Company Act of 1940, the Investment Advisors Act of 1940, the Securities Exchange Act of 1934. So I think I don't agree that the SEC is taking a backdoor to clear the industry. And in fact, I view it differently. I view this speech in particular as kind of an acknowledgement of the importance of the industry and an encouragement that technology continues to be explored and pursued in this country. But again, when you're capital raising, comply with the securities.
That's interesting. And Scott, I just want to switch gears real quick on a question. I don't know, it wasn't part of our framework here, but BAKKT BAKKT, basically by ICE Intercontinental Exchange, was supposed to launch I think today or actually in 2 weeks, but they're trying to build an open global network to buy, sell, and store digital assets. And they basically came out today and said they had to delay until next January, which I don't think will be received well at all. But they basically said they needed more time for testing and that the government was supposed to, or the SEC was supposed to review one of their offerings. Do you think that major announcements like this or major entities are delayed because of regulatory actions? Or do you think that, something like this might be more of just internal company stuff? Because I kind of find it hard to believe that they wouldn't have all their, operational ducks in a row by launch date.
So again, kind of the framework that the SEC is working under, from being a former regulator for so long, I kind of understand their perspective, and that is that the capital markets in the United States have been so successful for so long because investors are protected. Investors are protected because under the law, all material facts are required to be disclosed when there's an offering. And these disclosures are in the form of a registered securities offering statement or other types of disclosure documents that are provided to investors. And as you build from these frameworks, you have other built-in benefits that protect investors. Again, I think what is happening here is that there are a number of issues. We've talked about a couple of them: valuation and custody. Required disclosures is a third that need to be thought through to make sure that when this ecosystem goes live in a regulated manner under the framework of our country's securities laws, that each of the legal requirements of full disclosure of all material facts is achieved, and that the marketplace operates in a fair and even-handed manner so that investors are protected. That's what I believe is occurring. I'm with you that it'd be fantastic if these decisions and these issues could be worked out more quickly. I agree with you, that would be very helpful to the market generally. And I don't have an idea as to when this is going to be worked out. I did see, by the way, on that point, I did see a press article recently that discussed that there may be some additional guidance with respect to this early next year. And that press article was reporting again what the head of corporation finance recently stated at a speech he recently made, where he promised some further guidance with respect to this.
That's very helpful. Thanks, Scott. And just switching gears back to crypto. I mean, what's your take on just high level topics? Like, I'm interested in your take on things like Bitcoin maximalism or anything like that, because all the recent events that we're seeing kind of from the government is centralized entities impacting the price of supposedly decentralized ones. So, as the price of Bitcoin tanks because of actions against basically Ethereum's ICOs, it seems kind of weird that anyone would want to be a Bitcoin maximalist and, screw the government. But I'm kind of wondering your take here.
Yeah, so, when you look at the collapse of Bitcoin recently, the big question that I've had is, why has it been collapsing? What has happened recently that has caused it to collapse? I think you go back to the hard fork. Is it Bitcoin Cash that has occurred?
Yeah, Scott, it was the Bitcoin Cash hard fork was the drama that happened over the last 2 weeks.
With that type of activity where there's a disagreement and there's a hard fork in what was at one point one cryptocurrency is now two, it raises complexities, again, with respect to custody, with respect to valuation. It raises additional questions with respect to those.
Wait, so Scott, so the Bitcoin Cash fork, that would raise questions related to Bitcoin overall, or would those?
I think so because in my mind, if I'm an investor, I would be thinking, well, is it possible that Bitcoin could have a hard fork like this? There could be a disagreement and a hard fork, and then after that hard fork, could hard forks continue at periodic intervals? And ultimately, at the end of the day, what would that mean for Bitcoin? That would be a concern that I would express as an investor thinking through these things, and as a former regulator thinking about how these things are valued and what are the risks inherent with them.
Got it. That's interesting. So, what's your view at a high level, away from the legal stuff and where entities will have to meet the government and regulation? Just to close out, I mean, what's your view on crypto for the next, 3 months, 12 months, a year? I know you voiced that, you think that we'll work through a lot of these issues and that, we'll get to a better ecosystem. But I'm definitely interested in your shorter term thoughts. Maybe under a year if you could.
Yeah, kind of on a non-legal basis. I just should say, I find this extremely fascinating. The possibilities of cross-border payment system that's decentralized, extremely interesting to me. The rise of the stable coin, which would address some of the fluctuation of price issues to make it more of a stable currency to interact transactions overseas as easily as sending an email. I find this all extremely fascinating, and I know you asked me for the short term, and I'll answer that in a second, but with respect to the long term, I am a believer in this technology, and I believe this technology offers a lot of great potential in the future, and I look forward to kind of seeing where it goes next. For the short term, again, the immediate concern in the regulatory landscape, we spent a lot of time talking about that, and I just reemphasize in the short term, I think as some of these issues get resolved and some of these offerings, whether they're registered offerings or Reg A's, whether the ATSs or ETFs get approved and start operating, we're going to have the building blocks to build this regulated ecosystem in a manner which enables opportunity for market participants to get in, raise capital, and do other things they need to do to build their business. So I do think it's very interesting. Also, I would just mention it seems some larger companies, IBM and others, I'm sure there's banks and others very focused in the blockchain space, continuing to research and find applications for it, whether the blockchain is centralized or decentralized in these applications. I also think that's another very interesting area to follow.
That's interesting. Scott, one more before I let you go. I got to ask while I have you. I mean, does the crypto and government interaction, does this remind you of any, historical events or any other similarities that you think of, historically?
No, I mean, it's very interesting, and it's not only the technology, but it's the people behind the technology. I've never seen anything like this. I was at a conference in New York City, 3 to 6 months ago, and there were, entrepreneurs all involved in the ICO space, all Americans, with one exception. One lived in Switzerland, one lived in Singapore, one lived in Hong Kong, I think, and there was a French citizen as well who was also involved in the space, and they're talking about advocating people leave the United States and do their business overseas where the regulatory climate is more open and friendly. And you literally had this instance where the French citizen was asking, can anybody in the audience explain to me, why is America doing this? Why is America pushing off this tremendous technology and encouraging it to grow and prosper elsewhere? And of course, being a lawyer, you could see from our discussion today, I never stopped talking. I raised my hand. And we talked about many of the issues that we're talking about today, that the efforts of the lawmakers in this country to better enable small companies to raise capital, expand the exemptions, enable the exemptions to address issues such as non-accredited investor participation, use of the internet. There's also discussions on changing the definition of accredited investors. And I guess my takeaway that I want to leave everybody with is I really believe that the regulators see the opportunity. They have their job to do. They have to protect investors. There are a lot of good reasons why regulators should be suspicious of these types of offerings. And I think I fell in kind of my duty here if I didn't say, and there were a lot of investors who lost a lot of money in the ICO that had occurred in the last year and a half. There's no question about that. But I think that, I've never seen anything like this before. I think that this is going to move forward in a manner that complies with regulation, where there's encouragement for the creation of new technology, but also some requirements that the technology, when offered in a securities offering context, complies with established United States law.
That's interesting, Scott. I'm just thinking out loud here. I mean, another reason why I think that the government kind of has to take a light-handed or dynamic and proactive approach to ICOs is that this is only one use case on Ethereum, right? I mean, if they have to handle, potentially dozens or more, killer use cases, they might get bogged down or not be able to evolve in time to deal with them, right?
Yeah, I mean, the government has very limited resources. The government does a lot of things. And when I talk about the government here, I'm talking about the Securities and Exchange Commission. They can't bring every single case against every single violator. They can't. And I think with that, they're very selective about the cases and the information that they send out to the marketplace to alert the marketplace as to what is permissible and what is not permissible.
Scott, just beyond the ICOs, though, what about, future unknown use cases on Ethereum? It would be hard for the SEC to keep up with all of the new use cases. ICOs are just one of them. But no one saw them coming. If we have use case 2 through 5 that are evolving alongside ICOs, then that would be additional opportunities that the government would have to pursue. That it just sounds like, I just don't think that the government could evolve fast enough to actually police these things in an efficient manner.
No, the government's always behind the innovators. The innovators come up with the new ideas, the new use cases, and the government attempts to analyze those use cases as it learns of them and determine what is the legal framework with respect to those, meaning what laws do those use cases need to comply with. But my reaction to your comments is that in many of these use cases, we may not even be dealing with a security.
That's super interesting.
And if we're not dealing with a security, we're not dealing with this whole securities regulatory framework that we've been talking about.
No, that's super interesting. Well, Scott, where could people follow you and find out more about what you do?
Sure. So I would just suggest that people go to my website. It's finlawyer.com. It's a play on fintech, finlawyer.com.
Excellent. Well, Scott, it's a pleasure having you on. It was really, I know it's somewhat technical from legal, but we deal with technical networks all day. We might as well get involved in what matters most in the legal realm. So I really appreciate all your insight here.
It was a pleasure. Thank you so much for having me.
Thanks, everyone, for listening to the podcast. Please rate and review the podcast to help other people find it, and visit 51ect.io to see our research. Our listeners can join 51% with coupon code Thanksgiving, which expires soon.